The ETF SPY, which tracks the S&P 500, has a dividend yield of 1.49%. If we wanted to make $50,000 a year in passive income from the investment, we'd need a little over $3.3 million invested in it today. All right, that is a big number, and I can't afford that. What about the ETF QQQ, which focuses on tech stocks? I mean, tech companies make a lot of money. They should be giving some of that back to investors, right? Well, QQQ has a smaller dividend yield compared to SPY at 0.55%, which means if we wanted to make $50,000 a year, we need about $8.9 million. Clearly, we are going in the wrong direction. What about an ETF that focuses on high-quality dividend-paying stocks like the Dividend Aristocrats? In order to be considered a dividend aristocrat, a company must be paying a dividend for at least 25 years without pauses. It also needs to be in the S&P 500. And in addition, the dividend that they've been paying out has to have been increasing for the past 25 years as well, which sounds exactly like what we're looking for. The ETF NOBL focuses on these companies, and it has a 2% dividend yield, which means that if we wanted to make $50,000 a year, we'd need $2.5 million invested. All right, we are not made of money. It's obvious we need a higher dividend yield. There's a new kind of ETF on the market that blows these dividend yields that we just talked about out of the water, and they are called covered call ETFs. They sell options to collect premium, which is how they pay investors. One of these is JEPI, or the JP Morgan Equity Premium Income ETF, and it has an 8% dividend yield, which means that in order to make $50,000 from this ETF, we'd need $625,000 invested in it today. Okay, not nearly as much money compared to QQQ, SPY, and NOBL, but it's still over $500,000. Hey, I'm Raj, and on this channel, we talk about money. By now, you probably get the message that unless you have a ton of cash on hand, you're probably not going to be able to live off your dividends anytime soon. But there is a way to get to these high numbers that requires way less money up front. See, Albert Einstein said that compound interest is the 8th wonder of the world, and that's probably because a little bit of money invested over time grows slowly, but eventually grows exponentially. Well, sort of. That assumes a few things. More on that later. So the strategy that basically anyone can use to grow a large enough position to live off dividends is called the dividend snowball. Effectively, you would invest in a dividend-paying stock and invest on a consistent basis. Reinvest all your dividends, and over a course of period of time, after a few decades most likely, you'd probably have millions of dollars. At least that's the idea. Oh, and just as a reminder, a dividend is a payment that a company pays its shareholders just for owning the stock. Think of it like getting a paycheck from a company without actually having to work there. So let's do the math on how our money could potentially grow in the future based on past performance of SPY, QQQ, NOBL, and JEPI. For each of these, we're going to do 4 calculations. One where we invest $10,000 initially and invest $100 every month over the course of 30 years to see if we can get to $50,000 a year in passive income. One where we do the same thing again, but for 40 years. And one where we figure out how much we need to invest at one time and never touch it again for 30 years, except for reinvesting our dividends, of course, in order to get to that $50,000 a year in passive income. And one where we do that again, but getting to that 50K in 40 years. Now, the easiest way to make this a fair calculation is to use the ETF's 10-year average yearly return when possible. JEPI has only been around since 2020, so we're going with its average 3-year return, and NOBL quite hasn't hit the 10-year mark yet, so we're going to be using the 5-year return percentage. We'll be using monkeychimps.com's compound interest calculator to do the heavy lifting for us. And remember, these calculations assume a ton of information and are based on a small segment of the ETF's past performance. Future returns are never guaranteed, and this math also doesn't take into consideration taxes, inflation, prices of the asset changing over time, and basically anything that applies to you as an individual investor. So be sure to speak to your financial advisor before investing in any particular asset, because I'm not a financial advisor. I'm just some guy on YouTube. For SPY, we're looking for a position worth $3.3 million, and it has an average 10-year return of 12.46% according to Yahoo Finance. If we invested an initial $10,000 for 30 years and put in $100 a month, we would end up with $803,413, which is well below our goal of $3.3 million. But if we extended our timeline to 40 years, we get significantly closer and end up with close to $2.8 million. We wanted to have $3.3 million at the end of 30 years with no additional investments. We'd have to have started with close to $100,000. And if we wanted to do it in 40 years, we're looking at around $30,000 invested at one time. For QQQ, we're looking for a position worth $8.9 million today, and it has an average 10-year return of 18.64%. If we invested an initial $10,000 for 30 years and put in $100 a month since then, we'd end up with $4.2 million, well below our goal of $8.9 million. But if we extended our timeline to 40 years, we get an insane $27 million. If we wanted to have $8.9 million at the end of 30 years with no additional contribution, we'd have to have invested close to $50,000 at one time. And if we want to do it in 40 years, we're looking close to $9,600 invested. For NOBL, we're looking for a position worth $2.5 million, and it has an average 5-year return of 10.45%. If we invested an additional $10,000 for 30 years and put in $100 a month, today we'd end up with $477,897.99, which is way below our goal of $2.5 million. But if we extended our timeline to 40 years, we get significantly closer and end up with $1.3 million. If we wanted to have $2.5 million at the end of 30 years, we'd have to have invested close to $130,000 all at once. And if we wanted to do it in 40 years, we're looking at $47,000 invested. And finally, JEPI. We're looking for a position worth $625,000, and it has an average 3-year return of 12.08%. If we invested an initial $10,000 for 30 years and put in $100 a month, today we'd end up with $727,000, which is above our goal of $625,000. But if we extended our timeline to 40 years, we get a whopping $2.4 million. If we wanted to have $625,000 at the end of 30 years, we'd have to have invested close to $18,000 as a lump amount. And if we wanted to do it in 40 years, we're looking at close to $5,400 invested. Okay, before we get carried away, a lot of these calculations are just fun math and based on a lot of assumptions. But from the calculations, some general trends form that we should be aware of though. First, the longer you allow your investments to grow, the more money you'll make based on our 30-year versus 40-year calculations. That's because compound interest really kicks off after a few decades, and the growth is well on its way into a straight line after that 30-year mark. Second, the investment that you choose makes a huge difference based on growth of the overall position. The difference between positions in VOO and QQQ is potentially millions. And although QQQ is significantly more volatile and riskier, growth is significant. And third, small amounts of money invested can turn into significant amounts of money, as long as the asset is appreciating and given enough time to compound. This effect is especially powerful when used with a tax-deferred account like a 401k, or a Roth IRA where your investments can grow tax-free. Now, when it comes to dividends, we should talk about the pros and cons because there's important information every investor needs to know. First, dividends are a fantastic source of passive income. It's probably the easiest money we'll ever make because we just have to buy and hold the asset. And next, dividends can help fight inflation, especially when compounding really starts to get going. So if your inflation is on average 2% in an average year and your dividend is on average 3%, you're beating inflation, and you get to capitalize on the growth of the underlying asset over time, and dividend payouts can grow as well. Third, dividends are typically paid out by large, stable companies. So during tough markets, they can usually be seen as reliable cash flow, which is important if we're going to be living off of these investments. Now, of course, dividends aren't guaranteed. Companies will cut them if they need to save money, and that'll affect your income. So if you decide to invest in a single company, investors are going to want to keep a close eye on the financials to make sure that that dividend can be maintained. And because dividends are treated as income by the IRS, dividends can be taxable in certain situations. You're going to want to see how this applies to you based on your income, age, and specific investments. Some dividends are considered qualified, which means they have favorable tax treatment, and some dividends are not qualified, which means they have less favorable tax treatment, and in addition, this also depends on what kind of accounts you have these investments in. For example, if you have a dividend stock in a Roth IRA, that would likely mean that your gains and dividends are tax-free. But if you have it in a traditional Robinhood account, you're probably paying taxes as soon as that dividend hits your account. Next is that dividends aren't created equal. We want dividends that are as high as possible, as safe as possible, and as consistent as possible, and offer growth over time. Unfortunately, there's always a trade-off. The ETF QQQ pays a small dividend, and those come from tech companies that are usually more concerned with reinvesting profits to grow the business, not pay shareholders. And tech stocks can be more volatile compared to the overall market, so it's not exactly the safest thing for us to be counting on while we live off our dividends. Dividends from VOO and NOBL might be higher and more stable, but the overall position might not grow as much. And when it comes to things like JEPI, these covered call ETFs are relatively new, so we don't know how these are going to perform in various market conditions, which is risky, and the way they generate those higher yields adds complexity, which adds confusion, and it's important to understand what you own and where the money comes from. Finally, high dividend yields are attractive, but they can be riskier assets in general. They could be dividend traps, which is when an investment pays you a lot in dividends, but overall the asset is losing money, which is not the point of investing. So bottom line, if you don't have hundreds of thousands or millions of dollars, investing in the right dividend assets for a long period of time and letting compound interest work for you can be a way to get to the point where you can live off of your dividends. The math says it's possible. The good news is that since most of us are probably a few decades away from retiring, we have to build those positions. And let me know in the comments section what your dividend portfolio looks like, and if you found value in this video, click that like button, subscribe for more, and I'll see you in the next video. Take care.